Welcome to the Annual General Meeting 2019. Today we're going to talk about the proposals, the capital structure, and the potential lever to improve Carpetright's financial strategy. First, let's talk about the proposals, concretely about political donations and political expenditure. We recommend shareholders to vote in favour of the donation of £50,000 to bodies such as special interest groups, because one of the most immediate benefits of such donation is a tax deduction, resulting in the increase of dividend payments. Despite businesses can usually receive tax deductions from sponsoring charities or special communities events, cannot be ignored the fact that Carpetright must follow the rules and go about the process in the right way to comply with all UK's tax requirements. Regarding the share repurchase proposal, we advise shareholders to vote against it. Firstly, because share repurchase is usually the action of some companies that are making profit due to the amount of cash needed, while Carpetright is currently losing money and experiencing a lack of cash flow. Secondly, the leverage ratio is already very high, which will be discussed later, so it will be too risky if the company continues to decrease the equity now and make the leverage ratio even higher. In relation to the third proposal, we suggest shareholders to vote in favor of the deferred share bonus plan. Carpetright is going through a difficult time, and its sales declined by 13.4% in 2018. By delaying the dividend payment, the company can have more retained earnings to seek for more development opportunities and recover from the loss. The proposal we have decided to focus on is share allotment. We strongly recommend shareholders to vote in favor of this proposal because allotting shares can bring new capital which is necessary for the company. Moreover, the current leverage ratio is dramatically high at about 306%, and high leverage ratio means high risk. The share structure of the company will not be changed because share allotment means issuing new shares at a lower price to existing shareholders based on their share proportion. In other words, shareholders' share proportion will not be diluted, thus the impact on shareholders will not be obvious. However, once the resolution is passed, those who refuse to purchase allotted shares will suffer from a loss since the stock price will fall and they haven't got any benefit from the share allotment as a compensation. Now, let's talk a bit about the impact of this suggestion on the stock price. Since the new shares will be issued at a lower price, let's assume we allot new shares by 12p per share. The current stock price is 14p per share, and we allot one share for every 3 existing shares. Then, as shown in the slide, we can calculate the stock price according to these assumptions, resulting in 13.5p per share. Therefore, we can confirm its stock price will decrease after the decision of share allotment. Let's move into the second part, capital structure. In this section, we're going to analyze the company from 3 aspects: company's current financial strategy, value, and performance. Beginning with its leverage ratio, in 2018 it was of 970.47% and in 2019 of 306.84%, as shown in this slide. Apparently it's a dramatically high leverage ratio and will lead to many negative impact on the company, shareholders and investors. Consequences of a dramatically high leverage ratio include increasing the burden of satisfying debts, higher risk of default, higher cost of debt due to a higher risk premium, lack of confidence of investors on the company that results in more difficulties to finance in the future and more possible to get into financial distress. At first, we tried to evaluate the firm's value by using discounted cash flow to calculate its terminal value. However, it turned out to be difficult since the discounted cash flow is not applicable to companies which do not generate positive free cash flow. In the meantime, the 3 to 5 years free cash flow of Carpetright is hard to forecast according to financial analysts. In terms of this situation, we decided to use Modigliani-Miller proposition 1 with taxes to evaluate its value. However, when we are checking the income statement, we found that the free cash flow of the last year is negative, which means the company does not need to pay any tax this year. Thus, there will be no tax deductible. Since no tax this year, the interest tax shield has no benefit in this case. So we just need to figure out the value unlevered, which is equal to 202.2 million, as seen in this slide. In relation to the performance, has to be said that the company has had negative free cash flow during the past 2 years. Free cash flow measures a company's ability to finance its future investment, pay corporation taxes, pay interest on its debts, and make returns to shareholders. While from this bar chart, clearly the company has experienced a downward trend for the past 5 years, indicating a poor performance over these years. Turning to the shareholders' return, as it's shown in the table, there have always been large gaps between the return on shareholders of Carpetright and the market return, also implying a poor performance over the past years. The last point we're going to talk about in this video is our suggestion about the capital structure of the company. As was mentioned before, the current leverage ratio is around 306%. Under this dramatically high leverage ratio, the company is definitely facing a higher risk. We can also figure out the situation by its beta is 1.09, while the average number of this country is only 0.69. According to the capital asset pricing model, a higher beta always means a higher volatility, or in other words, a higher risk. One way to reduce its high risk we come up with is decreasing its leverage ratio. However, we have no idea of how much it should be decreased, so our first thought was to find out the average leverage ratio of the UK retail industry, but it seems to be difficult to find one. Thus, we turned to several similar companies who also account for a large market share in the retail industry and used their ratios to calculate an industry average leverage ratio, which is approximately 126%. It doesn't mean that we want to adjust leverage ratio to the market average. We just decided to lower it to a reasonable number, like 200%. Thus, to implement this suggestion, our specific suggestion is to have a secondary offering of £26.55 million of shares in the open market during the next fiscal year. In this slide, we can see the calculation process. Regarding the impact of our suggestion on shareholders and the stock price, a secondary offering now can benefit shareholders in the long run. By issuing new equity, the company can adjust its leverage ratio and increase the company's cash flow. It will be easier for the company to make profits in the future. Moreover, this action can increase the debt service coverage ratio, which means lower risk for the company of going bankrupt. On the other hand, it is true that issuing new stocks will dilute the equity of existing shareholders and lower the current stock price. The potential impact on current stock price is that as the quantity of the stock increases, the stock price will definitely fall. Since the current stock price is around 14p and the issuing price of the new stock should be a little bit lower than the current price, otherwise no one would like to buy, we assumed that we are going to offer the new shares at the price of 13p. Thus, the company have to issue 204 million new shares at the price of 13.59p per share in the next fiscal year. The slide shows how we got the specific number. Thank you for listening.